investing is about making money without moving a finger. There's a big difference in investing $10,000 into stock A and getting back $17 a month, or investing in stock B and returning $120 a month. Why would you want dividends over, let's say, focusing on a better paying job? Well, first, because better paying job is work, and we want to avoid working and enjoy the time on the beach or doing something that we love instead. Secondly, because it is an income that doesn't pay taxes. Reinvesting or snowballing has few general rules. A. If the dividend you receive is smaller than the price of the share, you can't reinvest it without putting in additional funds. B. Now let's address the dogma of all traders. Is there buying low and selling high in dividend investment? Let's dive in. Okay, say you followed the previous criteria and found this incredible share that pays out dividends and seems to be a perfect fit in your portfolio, but it is a major polluting business or a tobacco company. So do you have any other choices, or are you stuck with these stocks of immoral businesses who buy at our mercy through higher dividend yields? Luckily, there are. And this leaves us with conclusion that if you want to receive a regular high dividend income, then the optimal and relatively safe strategy would be to... Okay, let's go one by one in more detail, shall we? Imagine how would this feel. You're laying on the beach with a drink in your hand and you're making money. You go to bed in the evening and you wake up wealthier the very next morning. Or you may be watching TV and although the movie may be complete rubbish, but at least your bank account is growing as you're watching it. Yep, that's what I was talking about when I said that dividend investing is about making money without moving a finger. Honestly, if you're young and you're saving money for retirement, then you won't need to and you should not focus on dividend investment. But if you'd like to use the dividend money from time to time, it would be one of the best ways to allow you to enjoy the dividends real quick. So let's begin. The beauty of it is that it's up to you if you're going to be earning just a little, enough to pay off your Netflix subscription, or more, maybe even enough to pay off your mortgage, and you won't have to waste any extra energy for that. You may choose to reinvest your dividends so that you would be making even more in future. Gosh, it may even allow you to stop working entirely and start meditating, gardening, or helping in elephant sanctuaries, simply doing whatever you wish for the rest of your life. There are many companies that pay out dividends. It may be hard to find a way through those, but as a general guidance, it's mainly about your investment goal. If you're interested in seeing your portfolio grow, but not making use of the money till your retirement, then I admit that some growth stocks are a much better option for you. But don't worry, there are pretty big returns even on dividend stocks, so it may benefit you to listen in a little longer. And think of it as a spoiler, I'll be releasing a video about investment opportunities that outperform even S&P 500. Let's start with fundamentals. There's a big difference in investing $10,000 into stock A and getting back $17 a month, or investing in stock B and returning $120 a month. This is down to the dividend yield of each of the stocks you buy. Obviously, you would need to invest much more money into the first one to make some thousand a month. Let's review those two examples in detail. Stock A, the one that after investing $10K would pay out approximately $17 a month in dividends. It's a really great stock of a company that I bet you're familiar with, the Caterpillar, ticker symbol CAT. It's so-called dividend aristocrat, meaning that the Caterpillar paid out dividends each quarter over the past 25 plus years, while it kept growing its share price and the dividend itself. The catch is that the stock has dividend yield of only 2.02%, not uncommon among dividend aristocrats. And yes, you need to invest over $400,000 to start making $1,000 a month. Quite prohibitive unless you're a millionaire or you have a lot of time to save money if you want these investments to cover your retirement expenses in dividends. Assuming that you don't have 2 lifetimes to wait till you've saved enough to allow you to retire early, let's jump to option B, the one that would pay you $120 a month for just $10,000 invested. The asset is called the Global X Nasdaq 100 Covered Call ETF, ticker symbol QYLD. It is an ETF or an exchange-traded fund. If you're already confused by the abbreviations, worry not. I'll explain what ETFs are in a different video. So if your goal would be making $1,000 in dividends each month, then you would need to invest some $120,000. Not something achievable right away, but certainly something feasible over, say, 10 years, if you would be reinvesting your dividends and expanding on your investment each month. And trust me, there are better options than QYLD out there. By the way, why would you want dividends over, let's say, focusing on a better paying job? Well, first, because better paying job is work, and we want to avoid working and enjoy the time on the beach or doing something that we love instead. Secondly, because it is an income that doesn't pay taxes. Again, imagine you're in a position that you can spend time and money on a certification on a special skill set that is highly desired in your field of work. You do trainings, take vacations to study, spend time and money on getting the certification, let's say CFA, PMP, or even bigger sacrifice, an MBA. This would allow you to get a better paying job that would likely bear more responsibility, and you can expect it to be more demanding. But you've increased your income, so you've succeeded, hooray! But aren't you spending more time at work now? Just so that we are clear, I don't want to downplay studying or personal growth. It is a crucial part of not only our work life, but the life in general. In the end, you came to this channel to learn. Therefore, I'm not going to say that you have to choose one or the other. If you plan your finances accordingly, then you should be able to have both the education and passive income from dividends. But the thing is that if you start building your dividend portfolio early enough, then you will be allowed to slow down when the work starts to get too demanding. Again, but in different words. Having dividend income allows you to work less while not sacrificing your lifestyle. And that's true even if your dividend income is lower than what you've previously made in salary. How so, you may ask? Well, dividends are basically tax-free until you're making quite a lot. There are special rules with some types of ETFs and other assets that we will cover separately, but in general, you don't pay any taxes on your dividend income below around $40,000 a year, where for any additional dollar on your salary, you're already paying taxes, and it also moves you closer to the next income bracket. I've mentioned earlier that if you're not in the need of the dividend money, you may reinvest it. Reinvesting or snowballing has few general rules. A. If the dividend you receive is smaller than the price of the share, you can't reinvest it without putting in additional funds. B. The dividend payout frequency plays a major role in this. Let me explain. Imagine that you're holding the Altria Group stock, ticker symbol MO, with dividend yield of around 7.15% and stock price of approximately $48. You would need some 56 shares to pay enough dividends that you can take the dividend and buy another stock right away from the money you just got. If this stock would start to pay dividends monthly for whatever reason, you would need to hold 167 shares to be able to reinvest each month, and that is the difference of investing $2,688 versus $8,016. Remember, money that you just leave laying on your bank account is not working for you. And by reinvesting, you're effectively increasing your return beyond the original dividend yield, as every additional share is adding to the amount of dividends received from your original portfolio. The next thing to think about with snowballing are brokerage fees. If it costs you $1 to make a trade, then this may easily decrease the benefit of reinvesting your dividend, especially if you're intending on reinvesting monthly. So check your fees. We move to the next topic. If you like what you've seen so far, please hit the like button. It doesn't cost you anything and it means the world to me. Now let's address the dogma of all traders. Is there buying low and selling high in dividend investment? Let's dive in. The general answer would be, wait for it. No, of course not. Dividend shares tend to be stocks of major companies that compensate their slow share price growth with dividend payouts. This means that there is, generally speaking, a very low volatility in their price, meaning their price tends to be rather stable. But sometimes, just sometimes, there are exceptions. For instance, we've quite recently experienced a perfect opportunity for buying shares. The start of the COVID pandemic. As fear flooded markets, it wasn't uncommon to see stocks trading at a discount of 30 to 60% of their pre-pandemic price. And I'm still speaking about those dividend aristocrats here. So if you had a pile of cash at your disposal, then you were in a perfect position for buying very cheap, high-quality shares, as many of the companies that pay dividends are not a single product, high-risk small companies, but rather well-established multinationals with broad portfolio of products and services. Yet such market crashes normally won't happen more frequently than every 10 years. And waiting that long for a good position would mean that you would lose a lot on the increase in price of your holdings as well as on those lovely dividends. So no, don't wait for dividend stocks to fall and buy regularly instead. Okay, say you follow the previous criteria and found this incredible share that pays out dividends and seems to be a perfect fit in your portfolio, but it is a major polluting business or a tobacco company. So do you have any other choices, or are you stuck with these stocks of immoral businesses who buy at our mercy through higher dividend yields? Luckily, there are plenty of other choices that range from low risk, low return to high risk, high return, catering to your preference. Now, that was pretty abstract. So let's imagine you follow the previous steps and you've landed on Altria Group, ticker symbol MO, with dividend yield of 7.15%. You're planning to invest $300, allowing you to invest dividends into a new share every quarter if you'd want to, while having some $5 on the side. What could have you done instead if you didn't want to support a tobacco business that makes money by spreading lung cancer? Well, if you want a dividend aristocrat stock, then you can go for AT&T, ticker symbol ATT. That is cheaper stock with higher dividend yield of 7.42%. Or you may choose ETFs such as aforementioned QYLD with over 10% yield. Presidio Property Trust, ticker symbol UST, a rental business with 9.15%, Enbridge, ticker symbol ENB, with 6.76%. Just kidding. This company is a pipeline company transferring oil around North America. Though it is a stable, low-risk company, I would not invest in it, as I'm a fan of low-carbon future, and I may go for Green Codes, ticker symbol UKW, and UK wind energy company with yield of 5.33%, though there's a risk of change in regulated prices by UK government in future. What I'm trying to say is that there's plenty of choices where you don't need to rely on an immoral business, where the company spoils health of the customer or destroys our nature and environment. And this leaves us with conclusion that if you want to receive a regular high dividend income, then the optimal and relatively safe strategy would be to invest in stocks with ultra-high dividend yield. This doesn't require you to wait when the stock price is low. If you wish to reinvest, you may, but you won't be required to do that, and it would eventually help you improve your income almost right away. On the flip side, if your financial goals are focused on a distant future, then this kind of investing may not be for you. Yet, it can still complement your portfolio. Stay tuned for more investment opportunities and details about investment strategies with the subscribe and a bell button. And thank you very much for watching.